Most traders lose not because they trade the wrong strategy, but because they don't understand the structure behind price. Before you take any trade, you must understand what the market is actually doing right now. Welcome to Graph Insight. By the end of this video, you will know how the market really moves and the fractal nature of structure, how to identify real protected swings, how to separate external versus internal structure, what a valid break of structure, and how to spot a fake out, what a real change of character looks like. This video will reorganize how you see price forever. Let's begin. The market has only three possible high-level conditions. Uptrend, higher highs and higher lows. Buyers are in firm control, expanding price to the upside. Downtrend, lower lows and lower highs. Sellers dominate, expanding price to the downside. Consolidation, range. A sideways movement. This is a critical state. Price builds liquidity, engineering traps before the next big expansion. Everything, every strategy, every setup, every manipulation exists inside these three states. Before you enter a trade, ask this simple question. Are we trending up, trending down, or ranging? If you skip this, every trading decision becomes random and prone to error. Most traders think trends look like the textbook diagram. That's ideal structure. It exists only in theory. The real market looks nothing like that. The secret is not to make price look perfect. The secret is to understand which parts matter and which parts are noise. This leads to the most important distinction in modern trading. Every trend exists at a minimum of two levels simultaneously. External, major structure. This defines the protected swings and the high time frame trend. Major low, the lowest point before the impulse that successfully broke the previous major high. This swing point is protected by institutional money and should not be broken if the trend is healthy. Major high, the high created by that final breakout. These levels determine the actual trend, where we're reversing or continuing, and where institutional liquidity is resting. Internal structure, the noise. Everything that happens between the major low and major high. This is what you see when you zoom in. It is the major structure of a lower time frame. Internal structure helps with entries and short-term targets, but it does not define the high time frame trend direction. Most traders lose because they treat internal structure as if it were major structure, leading to premature reversals. Let's trace the evolution in a bullish trend. Price pulls back inside the major range, creating several small internal lows. One of these internal lows, usually the one at the extreme, generates a strong impulse. That impulse breaks the major high, confirming a valid BOS. That successful internal low then gets promoted to the new major low, protected low, for the next leg of the move. This process shows you how smart money transfers control from one swing point to the next, constantly refreshing the structure. Let's be precise about BOS. One of the most important skills in market structure is learning to recognize a valid break of structure and separating it from a fake out. A bullish trend accelerates when a major high is broken, but this break must follow strict rules. Let's walk through the three main scenarios. The first scenario is the classical and clean example of a valid break of structure. Price approaches the previous major high and breaks it with a candle body close above the level. When this happens, two things are confirmed. The bullish trend is continuing, and the major low is updated. The new major low becomes the lowest point before the impulse that broke the previous major high. This level now acts as the structural floor of the trend, and as long as price remains above this major low, the uptrend is intact. However, if price later falls below this new major low, we classify that move as a change of character. A major change of character signals that the bullish trend is weakening and that a potential reversal may be forming. The next scenario is where most traders get trapped. Price pushes above the previous major high, but only with a wick, while the candle's body closes back below the level. This is not a valid break of structure. This movement is typically a liquidity grab, a stop hunt, or a manipulation designed to trap breakout traders. At this moment, we wait for the next candle for confirmation. If the next candle closes below the major high, and its wick does not exceed the wick of the previous candle, then this entire attempt is considered an invalid break of structure. The highs and lows formed during this movement remain part of the internal structure, not the external structure. No trend continuation is confirmed, making this a classic fake out. The third scenario is more advanced but extremely important. Price first reaches the previous major high only with a wick, and the candle closes below the level, exactly like in the fake out scenario. However, the next candle behaves differently. If the following candle breaks the previous candle's wick, then this becomes a valid break of structure. Once that happens, we update the major high, we update the major low, the external structure is refreshed, and the bullish trend remains intact. This two-candle break of structure is extremely common in real charts because institutions often test liquidity before completing the breakout. Just like bullish trends have valid and invalid break of structure patterns, bearish trends follow the same structural rules but inverted. The first bearish scenario is identical in logic. Price approaches the previous major low and breaks it with a candle body close below the level. The new major high becomes the highest point before the impulse that broke the previous major low. This high now acts as the structural ceiling of the trend. As long as price remains below this major high, sellers remain fully in control. But if price later returns and breaks above this new major high, it signals a major change of character and a potential trend reversal. If price instead continues to form lower highs and lower lows, updating both the major low and major high, we classify this as bearish continuation. In the next bearish scenario, price pushes below the previous major low but only with a wick, while the candle's body closes above the level. This mirrors the bullish fake-out scenario. At this stage, we again wait for the next candle. If the following candle closes above the major low and its wick does not exceed the wick of the previous candle, then this confirms that the supposed breakdown is simply a fake-out. No valid bearish break of structure has occurred. In the final scenario, the first candle breaks the major low with a wick but closes back above the level. The next candle then forms a deeper wick. This two-candle sequence becomes a valid bearish break of structure. Sellers have absorbed liquidity beneath the level and confirmed continuation of the bearish trend. Let's now take a closer look at what change of character is. Change of character is the first whisper of a potential shift, but it is not a confirmed trend reversal. We categorize change of character into two critical types. A minor change of character occurs when price breaks any internal swing high or low. This only signals a pullback or a deeper retracement within the existing major trend. If you treat this as a reversal, you will be trapped the moment the primary trend resumes in its original direction. A major change of character is different. It occurs when price breaks the last major protected low or high. This is the first strong indication that institutional bias may be shifting. However, even a major change of character is not a confirmed reversal. It is simply an early warning that the previous expansion leg has ended. A change of character alone is incomplete and unreliable unless it is followed by a break of structure in the opposite direction. This combination is what confirms a true trend reversal. A real high-probability reversal requires a very specific three-step sequence. Memorize this sequence because almost everything else is manipulation. Step 1 is the major change of character. Price breaks the last major protected low or high. In an uptrend, this means price breaks the major low. Step 2 is the retracement. Price pulls back toward the supply or demand zone responsible for the change of character. This is the moment where institutions reposition and prepare for the next expansion phase. Step 3 is the confirmation break of structure. Price breaks the high or low of the retracement structure, creating a new BOS in the opposite direction. This confirms the new trend and completes the structural transition. This three-step sequence is the signature behind every real reversal in the market. Why does price behave this way? Because price moves toward liquidity before moving toward its intended direction. Liquidity sits above highs, below lows, and inside consolidations, and institutions require that liquidity to fill their large orders without causing slippage against themselves. Thank you for watching. If this video helped you understand price action the way institutions actually see it, give it a like and subscribe to Graph Insight for more deep, structured trading content. Let me know in the comments which trading topic you want me to break down next. and I'll create a full episode on it. See you in the next video.